Good morning, everyone. Welcome to this update for global stocks and commodities for the 7th of July, I should say. The title this week is that markets are very much playing to their own tune because there's a lot of negative things out there at the moment, and markets just seem to be ignoring them. And the US has set new highs. The Australian market is getting very close to 12-year highs, and it would certainly appear to defy some of the fundamentals, but it's really a situation of there is very little else where investors can go to to get any sort of worthwhile return, given the way interest rates are around the world. So it's a situation of pretty much equities or nothing much else. So that's the backdrop for this week. That there really just is very little substitute for equities, and there is also very little substitute for following the price action. Now, since probably 2013-14, people have been trying to call an end to this bull market because of debt and because of all sorts of reasons. But markets have continued just to grind their way higher and higher. And if you get caught up in the process of acting on news or forecasts, then it's going to end pretty poorly for you. So the overwhelming message, and it has been for a long time from me, and that is that there really is no substitute just to follow what the markets are doing. Ignore the forecasters, definitely ignore the news, because the news tends to get priced in well in advance. And that's just the best way to go about investing in this sort of environment where it's a completely contrived financial environment where interest rates are far lower than they should be, but there really is no way out. Now, eventually this plays out badly, but could be a long way off yet. I'll be covering just the normal stock and commodity trend updates. Gold has done well. Other commodities really just tracking along with the US dollar. And Portfolio Analyst last week, I do manage to get a few little breaks here and there during the year, and that was one of those weeks last week. Now, American stocks, the S&P gained 50 points on the week, which was 1.7%, so another good week. And the forecasters have just been consistently wrong for many years now. The economic data coming through in America is quite mixed. We're seeing some concerning economic data, and then the next month it flips back the other way. There was a very strong jobs report on Friday night, and we're seeing strong data in some parts of the American economy. We're seeing weak data in other parts, so it's quite a mixed picture. And certainly Europe, the economic data is pretty somber. There's nothing to get excited about in Europe. Japan just continues to grind on as it has done for the last 2.5 decades, with no real progress to their economic targets. And China also is struggling a little bit. Some of their economic numbers have just slipped into contraction. So it's not a particularly robust scene around the world. But it's central banks and tax cuts that are the main game. That's what markets are focused on. And as long as they believe that we're going to continue to see extremely low, or in many parts of the world, even negative interest rates, then equities are going to be supported, and to a large degree, irrespective of the valuation. On Friday night, as I mentioned, there was a jobs report that was stronger than expected. They were expecting about 160,000. They got 220, 240,000. And so the instantaneous response from the market was, oh, well, the Feds won't cut rates now next month. And so therefore the market sold off initially. But that only lasted for about 2 or 3 hours, and it turned around and ended up only just down very fractionally on the session. So this is what we're seeing. The computer algorithms kick in on a piece of news, but it just doesn't last. And we're seeing strong buying, into the end of virtually every session. And and that was again the case on Friday night. Now, earnings season is just about to start in America, so that'll be important. Stocks are priced for, I think, modest growth in earnings, and if that modest growth in earnings comes through, then there's no reason why this bull market can't continue. The US dollar moved back above the trendline support, which broke down a week or two ago, but it's now back on trend. And as I said, the strong jobs data just caused the market to reflect on whether the Fed would cut rates or not. I think it's pretty clear they're going to. I would be very surprised. They may not do it this month, but the trends around the world are pretty clear. The 10-year Treasury yield is still just hovering either just above or just below 2%. So that's the situation in the States. Let's take a look at the chart. So this is the S&P, and you can see the last 3 days we're at new all-time highs. So there was our peak in October, and we had quite a strong dip in May of this year, but it's recovered very nicely, and you can see we've finished just 10 points shy of the 3,000 point level. Let's just look at it on a bigger picture view, and you can see just the amazing rally that's taken place since the lows in 2009. A market that I don't normally look at in this service is the China index, the Shanghai Composite Index. You can see we had this amazing run up in 2015, where the Shanghai index got up to about 850 and then very, very rapidly plummeted down to about 470. So it ended up losing, by the time we got to the bottom, about 60% of its value. Now, since then, we've had a recovery, a dip, and this is starting to look like a higher low. We need to break above this level here, which is about 485 to confirm that. But the China market, as it should do, because it offers quite good value in terms of growth and earnings. The Nasdaq also trading at new highs as well, and the Russell 2000, whilst it's lagging from its all-time highs, it certainly reinforces the fact that this is a market being driven by a lot of breadth. This is not a market that is being held up by the FANG stocks and a few other big tech stocks. This is a very, very broad-based advance in the US market. Now, just turning to the currency, there's the US dollar. So we had quite a clear-cut trend channel upwards. We had higher highs and higher lows throughout. We then got this little breakdown that occurred in the second half of June, but we've now quickly recovered that, and we're back into the channel again. That's been buffeting the Australian dollar around, but we're still below 70 cents. We had a little peak over the top of 70 cents on Wednesday, but that was as far as it went, and we closed the week down at 69.8. Aussie stocks, there was our dollar, well off our weekly highs. Our index gained 130 points on the week, which was quite a strong result, and we're just 100 points off that 2007 peak, and seemingly defying reality, because the Australian economy certainly has plenty of concerns. So why are we now, having lagged the rest of the world for so long, why now are we making a run at these all-time highs when the backdrop to the Australian economy is so poor? And again, it's the same answer. It's the lack of viable alternatives to equities that is driving the Australian share market. Because when you look at, we're now down at a 1% cash rate. If you take off inflation, that means we've got a real cash rate that's now gone negative. So in real terms, we're at negative 0.3%. So that means if you've just got money in the bank at the normal cash rate, then take off inflation, you're actually losing ground year after year. And so people that wouldn't be in the stock market or wouldn't be in, let's say, the more risky growth areas of the market, they wouldn't be there. Well, they're lending additional buying support, and that's why the index is where it is. If you step back and look at the Australian situation on a big picture level, so a multi-decade level, and you certainly won't hear this from the RBA, but it's pretty clear that economic growth in Australia has come from excessive debt. So the debt has fueled the growth at various times, particularly in the housing market. And it's also the economic growth has come from immigration. So it's not come from productivity, which is what you want. You want to be growing an economy based on productivity. You don't want your economy growing just because the population is growing or because there's an excessive level of debt that's fueling that, allowing people to spend more and support the economy and to buy assets. So really at a big picture level, the growth numbers that the RBA and the government talk about, any government, are really an illusion. It's not real growth based on productivity. It's just not real. And it's really weird to sit back and look at the way that the world's financial system is now operating, because it's hard to imagine how it all plays out in the end. I just can't get my head around, where the end point is to this, because it seems to me that interest rates in Australia virtually can't be raised because the household sector would just fall over and die. So I don't know how we get back to sensible economic settings where where there is a risk-free rate of return, which is what modern day economics are based on. So it's going to be very interesting few years or decade ahead of us to see how all this plays out. Just have a quick look at the ASX 200. So there we are. It's been a really nice progression off the lows from December 2018. And if we pan right back, you can see there's the 2007 peak, and we're just underneath that resistance level there now. I would certainly expect, given those all-time highs of 12 years ago, that we would see the Australian market pause around that time. So while I'm here, let's look at gold. Here's gold on a weekly chart. So we managed to get above this resistance level, spiked all the way to 1440, gave it back again, and then firmed again to 1400 on Friday night. So a bit of volatility, which is what you'd expect around such a level. So this is pretty normal. I wouldn't have expected this just to blast through and then just keep going. But there's no question that gold is now in a very strong uptrend. So we've now broken out of this wedge, and gold is on its way. So we're just consolidating around 1400. The trend is up. That's all you need to know. Don't overanalyze it. You should have exposure to gold if you've got if you've got money in Australian money in overseas equities. Then holding GDX or gold overseas provides you with a double hedge. It provides you with a hedge against the market selling off. Gold should do better. And it also provides you a hedge against the currency. If the US dollar happened to fall and the Australian dollar went up, then gold would do well. So certainly for Australian investors in America, gold and GDX are extremely valuable assets to be holding. The Australian dollar gold price, that corresponds now to $2,005 an ounce. So we've been holding above $2,000 an ounce for some time, and that of course makes the Australian gold producers extraordinarily profitable, because the good ones have all-in sustaining costs of around $1,100 or less. So they're very profitable at those levels. GDX is also reacting around about resistance as the gold price is. So let's just take a quick look at GDX. You can see resistance here, had a little peep over the top. This is a weekly chart. The week before, we just dipped under it slightly, but again, quite clearly, we've got higher highs and higher lows. We had some nice volumes kicking in GDX. And GDX, as this little window at the bottom shows, the line is rising, the green line is rising, and it's above the moving average. So that means that GDX is outperforming the S&P 500, and that means that fund managers are really compelled to put more money towards GDX because they can't afford to be lagging the index. So good signs for the gold sector. In other commodities, copper eased a little bit, but look, these are just currency movements, and crude oil was pretty much the same, finished at 57.5. So let's just look at the charts quickly. Not a lot of movement there in copper over the last couple of months, and crude oil has rebounded off those low $50 lows of about 3 or 4 weeks ago. So to wrap it up, it's really important to watch the price action, not the forecasters. If you go with the forecasters and try and position yourself that way, you're just not going to get a good outcome. Slowing growth around the world is a concern, but there just is very little alternative to equities, and it would be a brave person to call anything other than a continual grind higher in equities. So that means that dips can be bought, not with a massive amount of confidence. So I think you need to be patient and wait for a dip. You need a strong game plan in terms of how you do your buying. Do you do partial buying? How do you set your stop losses? How do you take profit? You need to think all that out in advance. And certainly I spend time in Portfolio Analyst focusing on that sort of strategic approach to the market because it's just not a market that you can just buy and hold, I don't believe. I think you need a strong game plan around it. Portfolio Analyst this week, I've got a lot of questions on various Australian small caps, so I think members will find that very interesting. And if you haven't had an opportunity to try Portfolio Analyst on a 2-week $1 trial basis, then I think you would find a lot of very valuable information there. That's my contact details for anyone who's not a member of any of the services, and I'll be back with you next week. Cheers.